Welcome to the deep dive. So if you're watching the whole AI boom unfold, you know it's not just about the software, right?
Right.
The real complexity, well, it's the silicon. Literally trillions of incredibly complex semiconductors making up the foundation of, well, everything digital now.
Exactly.
And our main job today, our mission, is to figure out this. How do you actually invest strategically in the most fundamental part, the testing, the quality control that makes sure this whole AI revolution is reliable?
Right. And today we're diving deep into Teradyne Inc., ticker symbol TER. They're a huge player globally, a leader in automated test equipment that's AEE, and also industrial automation, or IA.
Okay.
And just for context, our analysis is based on their closing price on October 13th, 2025, which was $132.08 a share.
Okay, $132. And here's the core tension, the thing we really need to unpack. Teradyne, well, they're perfectly positioned, aren't they? They're the ultimate shovel seller in this AI gold rush. Every advanced chip needs testing. They've got a fantastic balance sheet, leading tech. But, and this is the big but, that stock price, $132, it feels like the market's already baked in perfection.
It really does.
So is this amazing company trading at a valuation that's, let's say, justified but really, really ambitious? We're looking at a range, you figure, between $115 and $140 per share based on the fundamentals. It's walking a tightrope.
That's the core question, yeah.
Now, before we really jump into the nitty-gritty numbers, just a quick word on how we do these deep dives.
Yeah.
This analysis comes from Stock Analytics AI. If you like this kind of detailed look and want priority deep dives on specific S&P 500 stocks, definitely like and subscribe to Stock Analytics AI. It's just €4.99 a month for members. You get priority access, and you can suggest tickers right in the comments.
Or drop a super thanks for a one-off.
Exactly. Drop a super thanks for a specific deep dive. Okay,
Yeah.
Let's get into it. Let's start with the absolute basics, the foundation of Teradyne's business.
All right, let's start with Chapter 1, the engine of innovation, a comprehensive business analysis.
So Teradyne really is all about testing, isn't it? They make these critical measurement tools, sell them worldwide. The main engine, the ADE segment, that's their semiconductor test business. No question, that's the core. It brought in about, what, 75% of their revenue in 2024?
Yeah, roughly three-quarters. And the rest, about 13%, that comes from the industrial automation side, robotics.
Right.
And that shovel seller idea is really apt because it perfectly captures their spot in the AI ecosystem. It doesn't matter which chip designer wins the AI race.
Someone has to test it.
Someone has to test that chip. And the key driver here is just sheer complexity. Teradyne's hitting this directly with their new Titan HP platform launch that's specifically designed for these super high-performance AI chips, the cloud infrastructure stuff, devices that need maximum testing speed and accuracy.
And this complexity point, that's sort of the hidden multiplier for them, isn't it? Like, when we hear terms like 3D stacking or chiplets, you might just think, oh, cool tech. But what does it actually mean for Teradyne's bottom line?
Well, it fundamentally changes the testing game. It means a huge increase in their value prop. Historically, you'd test one big monolithic chip.
Right.
Now, with chiplets, you're testing multiple tiny specialized components, plus the incredibly complex high-speed connections between them. It just explodes the amount of testing needed, the time it takes, and therefore the capital equipment required.
Okay.
That's what's driving that market growth projection. We're talking a CGR of maybe 6.2% to 9.3% just in the semiconductor test space. And that's helped along by demand from things like advanced driver assistance systems in cars, ADS, and 5G infrastructure too.
And the clever part of their strategy is that diversification, that dual engine thing you mentioned.
Precisely. Because let's face it, the semiconductor market goes through cycles. It can be volatile.
Always has been.
Always has been. So the industrial automation segment, the robotics part, it acts as a really important buffer. We're talking about collaborative robots, cobots, mainly from their Universal Robots unit. That market's actually growing even faster, maybe 8% to 10% CAGR projected. And the total market could be enormous, potentially over $400 billion by the early 2030s.
Okay, so that cushions the cycles, which brings us to their competitive edge, their moat. It's kind of an oligopoly, this space, right? So you need more than just good hardware. What makes it so hard for others to break in?
Well, first, there are high barriers to entry. Just the sheer cost of R&D is immense. But maybe even more critical are the high switching costs for customers.
The lock-in.
Exactly, the lock-in. Teradyne isn't just selling you a machine, they're selling an entire integrated testing ecosystem. Once a big chip maker or foundry gets Teradyne's AE systems deeply embedded in their production line, using their specific software platform like IGXL, ripping all that out to switch to a competitor, it's hugely expensive and disruptive.
Too painful.
Yeah, it's just too painful. And that creates a very loyal, very sticky customer base. And they're defending that moat aggressively. They've got something like 2,600 patents, plus strategic buys, like acquiring Quantify Photonics recently. That pushes them right to the front in testing silicon photonics, which is absolutely essential for these next-gen, high-speed AI data centers.
Okay, so the business structure looks solid. The moat seems deep. Let's switch gears now and look at the people actually steering the ship.
Okay, let's move into Chapter 2, Stewards of Capital, an evaluation of Teradyne's management.
Right, so CEO Greg Smith and his team, they seem to have a reputation for discipline, especially navigating those sharp industry downturns. They manage costs tightly.
They do. They've got a history of managing through the cycles pretty effectively with cost controls. A good recent example is how they restructured the robotics segment. They consolidated Universal Robots and MER to really streamline expenses there. They're not afraid to make tough calls, even in the growth segments.
Okay, and how does that discipline show up and how they use their capital?
Well, it mirrors that same focus. I mean, obviously, they reinvest heavily in the business internally, but when they look outside, their top priority for spending is strategic M&A, buying critical technology to stay ahead. We saw that with LightPoint for wireless testing, and now Quantify Photonics for photonics.
And what about shareholder returns? Are they just hoarding cash?
No, not at all. While internal growth is clearly the focus, they do consistently return capital to shareholders. Primarily through share buybacks, they did about $198.6 million in 2024. And they've set a pretty big target, $1 billion for 2025.
Wow.
Plus, they have a reliable dividend. They've raised it for 12 straight years now, currently paying $12.50 a quarter. It's not a huge yield, but it's consistent.
So buybacks and a steady dividend. But the real test of management, I suppose, is how effectively they use the capital they keep in the business.
That's right. And the key metric there is return on invested capital, ROIC. Teradyne's ROIC is sitting at 15.46%. Now, that's quite strong. It actually outperforms about 90% of their peers. And critically, it's comfortably higher than their weighted average cost of capital, their WACC. That's the textbook definition of creating real economic value.
Okay, strong management, creating value. Now for the ultimate stress test. Let's dig into the financials themselves.
All right, this brings us to Chapter 3, the financial bedrock, a rigorous financial analysis. So Teradyne, it's a large cap stock, market cap around $21 billion. Revenue, as we said, is cyclical, but it recovered to about $2.82 billion in 2024.
Now here's where I think it gets really interesting.
Yeah.
Those gross margins. You mentioned they're strong, but they seem exceptionally stable too, right? Consistently in that 59% to 60% band. They hit 58.5% in 2024. What exactly allows them to hold those margins so consistently when competitors must be fighting tooth and nail?
Yeah, that margin stability is really quite something. It's a direct result of those high switching costs we just talked about.
Okay.
They're not just selling hardware, they're selling these deeply integrated, often customized software and hardware systems. It's basically proof of their technological edge and, frankly, significant pricing power. For their customers, Teradyne's equipment is almost a necessary evil, and that lets them charge a premium.
Right. And even if the reported net income jumps around a bit because of those industry cycles, their ability to generate free cash flow, FCF, seems remarkably steady. They pulled in $474 million in 2024. That points to really good working capital management, doesn't it?
Absolutely. That resilience in FCF generation, even when earnings look volatile, shows they manage their operations very tightly. And underpinning all of this is their balance sheet. It's, well, pristine.
Pristine how?
They are effectively debt-free. Their debt-to-equity ratio is basically zero. Liquidity is also very strong. Current ratio around 2.35. Now, this conservatism gives them incredible flexibility, especially during downturn.
Or dry powder?
Exactly. But, the flip side is they are potentially giving up some growth acceleration they could get with leverage. It just underlines a very cautious, very strategic management approach.
Okay, makes sense. Now, for the number that really frames this whole debate, that PE ratio, sticker shock territory maybe, it's trading at a trailing PE of 45.7. That's way above its 10-year historical average, which is closer to 25.7. Why is the market paying such a huge premium for this quality?
Yeah, 45.7 is definitely demanding. It's really pressing in two main things, I think. First, all that technological strength and financial stability we just discussed, the quality premium. And second, this perception of almost guaranteed growth fueled by the AI revolution.
Right, the secular tailwind.
The market sees them as a fundamental beneficiary of increasing chip complexity. Now, if we try to quantify that using a discounted cash flow model, a DCF, let's assume pretty robust revenue growth, say 12% annually for the next 5 years. That kind of blends the high end of the ADE forecast around 9.3% and the midpoint for robotics around 9%.
Yeah.
If you run those numbers, that DCF model spits out an intrinsic value range of roughly $115 to $140 per share.
Okay, so the current price is right at the top end of that range. That sets the stage perfectly. Let's shift now from the company's fundamentals to how the market is actually reacting and trading this stock.
Okay, moving on to Chapter 4, Market Sentiment.
And this is where it gets really interesting, a real battleground stock. The analyst consensus is technically a moderate buy, but you got to look closer. The average price target from those analysts is $122,
Right.
which is actually below where the stock is trading now at $132. That screams disconnect, doesn't it? It suggests the analysts on average think it's a bit overvalued, but the market's pushing higher regardless.
Yeah, the market's definitely showing conviction. You see it in the momentum metrics. Despite that analyst caution, the stock is trading more than 42% above its 200-day moving average. It's strong, bullish momentum.
So the street is betting on a faster AI recovery.
It seems like it. The market appears to be pricing in a much quicker or maybe stronger AI adoption cycle and testing demand than the formal analyst models are projecting. But confirming this whole controversy, you also have significant short interest. It's moderately high at 6.67% of the float. That's a decent chunk of capital betting against the stock, likely based on those exact valuation worries and the historical cyclicality.
A lot of disagreement then. So let's see who actually holds the shares, who's making these bets.
Good question. Let's look at Chapter 5, Ownership Structure.
Okay, and it looks like institutions dominate here.
Massively. Yeah, 99.6% of Teradyne shares are held by large financial institutions, and it's heavily weighted towards the big passive index funds, think Vanguard, BlackRock.
Right, the usual suspects.
Which, provides a stable ownership base, but it also means the stock's performance is tightly linked to whatever the broader market and semiconductor sector indices are doing. It gets swept along.
Yeah. Okay, but what about the insiders? The people who know the business best, what are they doing?
Oh, now that's a critical piece of the puzzle. Insider holdings are actually very low, only about 0.313%. And here's the potential red flag, something every investor needs to notice. Looking at transactions over the last 90 days, they've all been sales.
All sales, no buying at all.
All sales, including shares sold by the CEO, Gregory Smith, back in September 2025.
That feels significant. I mean, the stock is trading right at the upper end of your own DCF value range. Should we read this as management thinking the stock has kind of peaked for now, or is it just standard diversification and selling for personal reasons?
That is the million-dollar question, isn't it? And it's hard to know for sure. Executive stock sales happen all the time for perfectly valid reasons, diversification, tax planning.
Sure.
But the complete lack of any insider buying at these valuation levels, especially for a company that's debt-free and has such strong long-term potential tailwinds from AI, well, it does suggest that maybe management feels a near-term upside is already reflected in the price. It certainly doesn't scream confidence in significant further multiple expansion from here.
Yeah, it tempers the enthusiasm a bit. Okay, let's put it all together now and focus on the potential downsides, the stress points.
Okay, let's synthesize this in Chapter 6, Risk Assessment. We need to balance the internal weaknesses against the external threats.
Right. So internally, the big ones seem pretty unavoidable for this kind of business. First, that inherent cyclical nature of semiconductor capital spending. It goes up, it comes down.
Always a factor.
Second, customer concentration looks quite high. You said the top 5 customers make up nearly half the revenue, 48%.
That's right. So if just one or two of those big guys decides to pause their spending for a quarter or two, it hits Teradyne's results hard.
Yeah, big impact. And third, you mentioned the robotics segment. While a diversifier is maybe not firing on all cylinders, it's underperforming a bit, even after the restructuring.
It's still finding its footing relative to expectations, yeah. It needs to deliver more consistently. Now, externally, the biggest threat is probably just intense competition.
Who's the main rival?
Advantest. They're the other major player. And, critically, Advantest currently has the sole source position for testing NVIDIA's GPUs.
Ooh, that's huge. NVIDIA GPUs are central to the AI build-out.
Exactly. That's a massive high-value slice of the high-performance computing market that Teradyne is largely locked out of right now. So the success of that new Titan HT platform we mentioned earlier, it's absolutely critical for Teradyne to try and win back some of that specific share.
Okay, huge competitive pressure there. And then there are the macro risks, the geopolitics.
Always lurking. The U.S.-China trade tensions, potential tariffs like the ones mentioned for 2025 on finished electronics, those create persistent uncertainty. But interestingly, geopolitics is also a major opportunity right now.
How so?
Well, beyond the obvious massive demand drivers like AI, HPC, and 5G, you have this huge trend of supply chain regionalization or onshoring. Policies like the TER Act in the U.S. are actively encouraging companies to build semiconductor facilities outside of Asia.
Right, bringing production closer to home.
And that significantly expands the total addressable market for test equipment makers like Teradyne in regions like North America and Europe. And the data actually seems to show that this government policy push, like the CHINDS Act funding, is currently a stronger driver of investment than even negative forces like rising interest rates. It's overriding the typical macro cycle, at least for now.
Fascinating.
Yeah.
So government policy is providing a tailwind. Okay, time to bring it all home, synthesize everything.
All right, let's wrap this up in Chapter 7, Conclusion.
So, summing it all up, Teradyne. Clearly a world-class company, market leader, fantastic financials. You see it in those 60% gross margins, the debt-free balance sheet. That's the bull case, loud and clear.
Absolutely, but the bear case is equally clear and rests almost entirely on that demanding valuation, the PE of 45.7. Plus, you have the unavoidable industry cycles, the intense competition, especially for that NVIDIA business, and maybe that little warning signal from the insider selling pattern.
Okay, and checking that valuation one last time against the price. The stock at $132.08.
It lands squarely in the upper end of our estimated intrinsic value range, that $115 to $140 per share, calculated from the DCF.
So what's the final takeaway for you, the listener? What does this all mean?
Well, it means the current valuation is arguably justified, right? Based on the very real long-term growth story driven by AI complexity, their clear technological leadership, and that fortress balance sheet. But it leaves virtually no margin for error. There's no room for disappointment or negative surprises, whether it's a delayed product cycle, a major customer pausing orders, or intensified competition. The stock is priced for continued strong execution and for those AI tailwinds to keep blowing hard. It's priced for high expectations. And, this brings up a really important question, I think, especially for long-term investors. We see strong evidence right now that massive government interventions like the CHINDS Act are actually overpowering traditional economic headwinds like rising interest rates when it comes to driving this specific capital spending. The question is, how long can that geopolitical tailwind last? How long until the fundamental inherent cyclicality of the semiconductor industry inevitably kicks back in? That underlying uncertainty, well, that's really the core risk you're taking on at $130 a share.
That's a really powerful point to think about the policy tailwind versus the cyclical reality. A great place to leave it. If you want more deep dives like this one covering S&P 500 stocks, please do remember to like and subscribe to Stock Analytics AI. Members get priority access to our research pipeline.
And just the standard but important disclaimer. This analysis was generated by an AI system. It's intended for educational purposes only and should definitely not be taken as financial advice. Please always do your own thorough research or talk to a qualified financial advisor before making any investment decisions.